Good morning, everybody. Happy Wednesday. Hope you all are doing good. It is Wednesday, February 18th, which means tomorrow is Thursday. Take your Thursdays. We're going to do a bit of a mix of things here today. We continue to have rather muted equity markets, U.S. equity, and actually other equity markets too, on an index level year to date. But there's actually a lot of stuff going on underneath the surface. So we're just going to give it like one more minute or so before we get started. So if you guys have any questions in the meantime, just let me know. Quickly press something here. Okay. Good. Okay, let's just get started. I think we're ready to go. Again, hey everybody, happy Wednesday. This is our Set the Market morning call here at thesteadytrader.com. I'm Serge Berger. I'm looking forward to spending the next sort of 10-15 minutes with you guys here this morning. If you're here for the first time, please make sure you subscribe to the channel. It allows you to be updated in real time when we go live with our analysis. Also, if you could please do so, is give us a thumbs up like on all the videos and things that we have going on here, including this one here right now. So as a quick reminder, from a performance perspective, I'm going to make this a bit larger. I got a whole bunch of different asset classes here, but this is the year-to-date performance of a whole bunch of asset classes. It's a bit sort of squished together, but you can see energy stocks are up 20%, uranium is up 20%, copper, material stocks are up, doing really well, and the S&P 500 is flat, the NASDAQ 100 is down 2%. So a lot of people are looking at their portfolios now and are wondering, what's going on? Why are they not making money? This is a recurring theme. We've talked about it for months and months and months, for most of last year. And that is when big tech doesn't lead the equity market on an index level, U.S. equity market, S&P, that kind of stuff, mathematically cannot go higher, which means for the most part that most people's portfolios at home, IRS, all that kind of stuff, cannot go higher because they're all benchmarked to the S&P, which is basically hijacked by 7 stocks. 7 good companies, but stocks that likely are going to start consolidating from a bigger perspective, and they have already. It's factually taking place. So that's just a quick FYI. What I'd like to show you, though, is there is a lot of opportunity. Even the German DAX is actually up 3% again this year so far. And I'm going to show you guys this quickly. There's a lot of opportunity outside of where most people are watching. And that's really kind of the, again, the problem that we see, that people are simply unwilling to let go of stuff that that has worked so well for so long now. Meanwhile, performance continues to be in other places. So, for example, this here is the German DAX index. Now, I'm going to show you guys the U.S. listed ETF, so you can look at this as well for those of you folks that prefer that. But this is not exactly, just subjectively, this is not a bad looking chart. If you look at this versus, let's say, the NASDAQ 100, we could even do a ratio chart if we want to later on, but just so you guys can see, this is like the inverse of that, right? I'm going to put it like this so you can see basically the DAX making higher lows, the NASDAQ 100 making lower highs in blue. Now, it's not the end of the world. We do have a bearish momentum now in the NASDAQ 100. It's not the end of the world, but it is certainly a change of scenery. If you're looking at, for example, through a U.S. listed ETF, we can look at this on the EWG ETF. This is the German DAX. I'm going to quickly give it to you here like this. So EWG, obviously, it looks more or less the same as the DAX. Again, this is relatively way better looking than the S&P 500. I know this is not a popular opinion, but just so you know, it's not always U.S. stocks and only the S&P that does well forever. The U.S. stocks did horribly for almost 10 years up until this most recent rally. So you just got to keep that in mind. Things change, money rotates. But of course, 15 years ago is a long time. It's, as I keep saying, a good friend of mine tells me it's long enough to erase memory for most people. So keep that in mind. The other thing I want to look at this morning is gold, right? And I actually made a video on this just to give you a bit of perspective on this. Again, most people woke up to the big gold rally at some point last autumn, at which point they had one more hurrah and then basically topped out in January. So I want to give you a bit of an update on gold so you can kind of see where that is. Gold, for the most part, I'm just going to give you the GLD ETF for those of you guys using our trend following model using the market rover. You can see that we have a very strong trend still intact. So this is the trend following model. That trend started, and we called it out at the time for months and months. In January 2024, gold remains in a bullish trend that is undeterred. It still remains in that longer multi-quarter, multi-year bullish trend. However, what we did have in gold is an extremely overbought signal. Not only did we have it once in October of last year, in which case gold corrected 11% and stayed and was not able to overcome those highs for like 2.5 months, but it also happened again, and we called it out here live and certainly to our clients in late January, upon which gold dropped 17% and basically hasn't done a thing. We think gold is a consolidation phase from an near to intermediate term, so that's multi-week, maybe multi-month. We'll see where it goes after that. We don't have it's so consolidated in such a consolidation phase that it doesn't even have bearish momentum yet. It remains long-term bullish trend. In the short term, it's basically in a chop zone. It got extremely overbought. So from a trading perspective, from my perspective, there's not a whole lot to do here right now in the price of gold. Silver, more or less the same exact analysis. The only difference with silver is it's a hell of a lot more volatile. A lot of people got margin calls in silver as the chart chasing continued. Let me just quickly show you this. So this is the price of silver. Just keep in mind, when we use something called average true range, which expanded like crazy over the course of the fourth quarter last year, which is why margin requirements in the futures of silver went through the roof. But silver from peak to trough so far has corrected 47%. It's now a bit up from that, but that was the drawdown. Silver is very volatile, and I think a lot of people don't understand that, but a lot of people did probably learn a bit of a lesson that over the past number of days, couple of weeks or so. So just keep that in mind. It's a volatile thing. Again, happy to take some ticker symbols if you guys want. From my part, I want to point out really just two more things. One of them is the 2-year yield. I know this doesn't make for very sexy conversations when it comes to the retail investor, but we're here to educate and make people understand that if we see 2-year yields on the Treasury note drop somewhere below where it bounced once again, so it's somewhere below 3.5%, and it's got to stay below there. I think that could start to give us a bit more panic, maybe 3.3 maybe percent or so. I think if we drop below there, that's where the equity market could start to be a bit more concerned. You saw yesterday yields went back up. The equity market loved it. And sort of happy days, right? But I would watch this very closely. The VIX, in the meantime, which I always take with a good grain of salt, it's more or less in no man's land. It's certainly no longer in the low teens. So it's now sort of closer to 20-ish. The S&P for its part is really doing absolutely nothing. As I showed you year to date, the S&P is flat. The Nasdaq is down a couple percent. So on an index level, something is going to jolt this market. I don't know what it is. I'm sure someone on Twitter can tell you, particularly someone with no experience at all, will be very vocal about a very factual opinion. But, in the world of realism, of when we look at the market through the lens of, we actually want to make money, not just gamble, we need to understand that we don't really know what's going to jolt this market. There's plenty of news coming. Next week, we have NVIDIA earnings. So a lot of stuff can bring about some volatility here. It's factually important to understand that the S&P's done absolutely nothing essentially now since late October of last year. The Nasdaq is down, and something will ultimately move this market, either break it higher or break it lower. I don't know which way, honestly. I most likely think it's going to be lower, but I'm very open-minded at this point. So at this point, I want to leave it open to any potential questions you guys have. We're going to keep it rather short and sweet here today. Happy to entertain any more questions, but I hope this has been helpful. We are going to be back tomorrow, Thursday, for our Ticker Thursdays edition of this. I will tell you, we talked about this yesterday with our Market Rover members, we are seeing a lot more trends change. Microsoft changed its trend. Not only did Microsoft change its bullish long-term trend to neutral weeks and weeks ago, but it actually now is in a bearish trend, which is a whole nother beast. Doesn't mean the stock goes to zero. It just means that it's no longer in a bullish trend, right? So things are changing below the surface, not the end of the world, but certainly a different market than we've had for some time. So with that, if there's no further questions, what we'll do is we will, Goldman really quickly. Yeah, look, the financials are having a problem, right? So we're starting to see financials act a bit differently. Goldman too has done absolutely nothing since December. So I'm not quite sure there's a whole lot to do here. Goldman itself looks okay, but the financials more broadly, if you look at the sector, is slowly moving its trend a little bit. It's not the end of the world. Momentum is slowly starting to change. But again, I think the overarching point here, whether it's Goldman or some of the other names, they're essentially range bound. I would be very concerned here to put on any trades with any real conviction at this point. I think we're trotting sideways. Certainly one could put on trades. I'm not saying there's nothing to do. I think from a probability perspective, for me, these markets are sideways, and underneath the surface, things are slowly starting to weaken a little bit. So with that, folks, thanks so much. We'll see you guys back here tomorrow for Ticker Thursdays. Please give us a thumbs up, like, subscribe to the channel, and we'll see you guys back here tomorrow. And if you are a Trade Ops member, we'll see if there's a couple of trades to do here today.